game is this. Institutions are the primary sellers of options. Generally, you don't hear about people, retail investors that are selling options. Some do, but if you look at the data, it's clear that 99.5% of all options contracts are sold by institutions to the retail investor. Now, when a retail investor, you or me, buy those options, we pay a premium to own that, right? So we're paying a premium to own that option. Now, the kicker is this. The institutions maximize profit. They get 100% of that premium as an options profit if that option expires worthless. So again, if you think about it, when you're talking about in the trillions of dollars in options that are expiring, there's an incentive for institutions to potentially say, hey, listen, if we're going to make $100 million or $1 billion on our options premiums, let's use half of let's use 50 million to prop up the markets to keep them from expiring or from essentially paying out the retail investor. Now, again, if your option goes in the money, then that either comes out of the premium that the institution is getting, or if it's a big profit, then the institution actually loses money. We know institutions don't like to lose money, right? So there's an added incentive to make sure options expire worthless. Essentially, what you look for is where do a majority of options puts and calls, where's the biggest profit price for the market to end? And if we look at this, and I want to show you this, guys, because this is some big stuff here. If we flip over to our S&P chart, and I want to go to our daily S&P here, what we can see is that yesterday we've been watching this wedge pattern for this last week or two, even in spite of some of the negative news. CPI data much hotter than expected, PPI data much hotter than expected, retail sales worse than expected. Like essentially, as I said to you guys yesterday, every economic data point has been bad news here recently, right? Maybe you could say jobs are the only thing holding up, but the bottom line here is we were below in the last 30 minutes of the day. We were trading basically at the lows of the day. And to show you guys this, I'm going to flip over to my 10-minute chart. Let me get rid of this is the 10-minute chart. So each of these candles is 10 minutes. 30 minutes at 3:30 p.m. Markets close at 4 p.m. stock market time, Eastern time. We were down here at 3:30. In the last 30 minutes, they jacked this market up. And you say, well, what changed? What happened? Why did the markets get such a massive bid on the S&P and the NASDAQ where ultimately we ended closing back above this technical level? And the answer again, when I realized this, is duh, it's options expiration. So again, at the open, we will have a huge amount of index options expiring. And my guess is the institutional money said, where do we maximize our profit? We need to keep the market in this tight range because there's a ton of calls that we're betting on a breakout and a ton of puts that we're betting on a collapse. Well, guess what? None of that's happening as of today's at the open, right? So essentially, they're going to maximize most likely their profit. They probably had to use some of that profit to keep the markets up late in the day yesterday. But nonetheless, there you have it, guys. That is quite the game to be played. Big money games here, guys. Big money games. Okay, so let's go on. Let's go back to our party started, get something going, at least give us some volatility. Unless we really sell off in the next, minute and a half before the market closes, it looks like we're going to close on the line. Now, tomorrow's Friday and it's Options X. So there's a lot of people out there. For those of you guys that don't know, Options X is when a majority of the monthly options expire on that Friday, the third Friday of the month. And the kicker here is that a lot of times institutions will try to hold the market up so that they can get a majority of essentially of those options that they've sold to expire worthless. And just to break that down even more,
please.
Essentially, if you look at all the options that people buy, you don't really hear about people selling options. Institutions do that. And when they sell options, they take a premium from you when you buy it.
Okay.
Now, it's in their interest to have that option expire worthless for you because they get all of that premium as pure profit. When you make money on your option, that comes out of their premium, or they could even lose money. So my question here is, are they trying to hold this market up going into Options X so that they can maximize their profit here, where they get the most calls and puts to expire worthless and bank the most money? Once Options X is over, I wonder if we do see that market really start to come down, because this news, it's bad. I mean, you now have inflation.
Though, right?
Which part? Some more education. All right, a stock is coming down, right? You're like, okay, this is a great level to buy. Great level to buy. And then just before it gets there, it goes like this. It missed your level, and now you're getting a bounce on it. In fact, you're getting what I would refer to as a potential bear flag. That negates this level now, okay? You don't want that level anymore. This is what we call an in-spirit of tag of the level, or hit of the level, and essentially it's the equivalent of it hitting it, which means if the bear flag plays out, you have to worry that it's going to cut through that and go to your next level. I like charts that go directly with no bounces, no bear flags into my technical levels. If you get a bounce before, you have to understand that that could throw a wrench in your perfect thesis. So again, just keep that in the back of your mind as well when it comes to trading. All right, lastly, JB, there's an M pattern, okay? Look at the M and look at the A. Now, this is a classic topping pattern. It's an M pattern. In fact, for those of you that follow Bitcoin, remember Bitcoin in 2021, what did Bitcoin do? Went like this, went like this, went like this, and then collapsed, right? So again, look at that same sort of pattern. Now, we have something called an A. So an MA pattern is a bearish technical pattern. One of the reasons, and this is something I teach in the Winning Trader series, is that what you look for is when you see the M form, you don't short it. You don't short it because it's going to generally, more times than not, get a bounce off of this longer-term trend line. What you look for is the A formation. And when do you short when you have an MA pattern? Let's talk about it. Basically, what you do is you take the middle of the M, and when you get the bounce, you should retrace right into that zone right there. That's when you take a trading opportunity as a TA expert, right? So again, just to go over this, here's your M pattern, right? And then it bounces off the technical level, whatever that is. And then once you get back to that midpoint, that's when the short becomes optimal. All right, so now what's the reverse of that? Let's go into a little more education here. I know you guys like the educational stuff. So what we look for is the inverse of an MA pattern is a WV pattern, right? That's a bullish pattern. So this is a bearish pattern. A bullish pattern would be a WV pattern. W, okay? And then V, same thing. So notice it's just the inverse of that. And essentially what you look for is you don't buy up here, right? You don't buy the breakout. Like a lot of people will be like, oh, it's breaking out above the high. If you did that with Bitcoin back in 2021, you paid 66, 67, 68, or 69,000. Not the smartest thing to do, right? In hindsight. Now, ultimately, what you're looking for is that pullback of the V that goes like that. That's your zone right there. Now, could it go a little bit below? Sure, it could. And listen, how do you know when you exit the trade? Well, if you ever negate the W pattern down here, then you got to exit the trade, right? I mean, that's where you get below that pattern formation, and you have to be very, very aware of that. Okay, so going back to this chart, we got the MA pattern on earnings, and in this case, you got a lot of factors. Not only the MA, but then you also have head and shoulder, right? Now, you hadn't curled over yet, so you hadn't triggered it. Trigger line is right there. But certainly today we're triggering it, and we're trading at 500 right down here, right? All right, so now let's talk about where there will be support. Where is support on